A title slide appears. It reads, Full Year 2025 Results. Beneath it are the names Fernando Fernandez and Srinivas Phatak, followed by the date 12th of February 2026. A large outline of the Unilever U sits on the left against the blue gradient background. Safe Harbor Statement appears. A link to the full text of the statement can be found in the description for this video. Fernando Fernandez, Chief Executive Officer, stands in an office space, facing the camera in a dark blue suit and white shirt.
Hello and welcome to Unilever's full year results announcement. Thank you for joining us. In a moment, Srinivas Phatak, our Chief Financial Officer, will take you through a detailed breakdown of Unilever results for 2025. But before that, I would like to share with you a few reflections on our performance last year. Let me start by saying that we have delivered a solid year, fully in line with our commitments, despite challenging conditions. When I took over as CEO, I made clear that one of my biggest priorities was to ensure that in Unilever we could both perform and transform.
A slide appears titled, Solid Performance While Transforming. One numbered point is shown. It reads, Competitive performance, improving volumes leading to 3.5% USG and plus 60 basis points UOM.
2025 has demonstrated our ability to do both. We deliver a good performance, delivering competitive volume growth, positive mix, and gross margin expansion, with sequential improvement throughout the year.
A second numbered point appears. It reads, Sharper portfolio, 15% rotation, demerged ice cream with 10 transactions in 2025.
We sharpened the portfolio. The successful demerger of ice cream, combined with 10 deals, including acquisitions like Minimalist, Wild, and Dr. Squash, and the disposal of several non-strategic brands, means that we have rotated 15% of the total portfolio in 2025.
A third numbered point appears. It reads, Elevated brands, premiumization, and social-first marketing at scale.
We have significantly elevated the offering of our brands, stepping up their functionality, their aesthetics, their sensorials. Strong innovation plans and a decisive shift to social-first demand generation models also contributed to a strong improvement in the admissible brand superiority scores of our brands, a key reason for our ability to outperform markets. This is then powered by another increase in our brand and marketing investment.
A fourth numbered point appears. It reads, Improved execution, developed market strength, successful resets in Indonesia and China.
We improve our execution, reflected by our continuing strengths in developed markets and our improved performance in emerging markets, including the successful operational resets in key markets like Indonesia and China. We have also acted decisively to correct performance gaps in areas like home care and deodorants in Brazil or US hair, businesses in which we expect significant improvements during 2026.
A fifth numbered point appears. It reads, Cost discipline, cumulative €670 million productivity savings, driving 50 BPS overheads improvement.
We drove cost discipline and improved overheads by 50 basis points through the continuing delivery of our productivity program that is significantly ahead of schedule. We are moving at speed to build a business that drives desire at scale in our brands and execution excellence. There is much still to do, but we have entered 2026 as a simpler, sharper, more focused business, better able to capture the many growth opportunities that exist across our categories and our channels. Our performance in 2025 gives us added confidence that we are on the right track, as Srini will now highlight in taking you through the numbers. Srini.
Srinivas Phatak, Chief Financial Officer, stands in an office space, facing the camera in a dark suit and white shirt.
Thank you, Fernando. Before I turn to the results, just a brief point on the basis of reporting. All the figures that I referred today are on a continuing basis, which excludes ice cream. Comparative figures have been restated to reflect the demerger of the ice cream business, so all growth, margin, and cash metrics are presented on a like-for-like basis.
To Srinivas's right, a slide appears titled Full Year 2025. It shows three figures: 3.5% underlying sales growth, 1.5% underlying volume growth, and 2.0% underlying price growth.
For the full year, underlying sales growth was 3.5%, with volumes at 1.5% and price at 2%. Looking beyond the single year, performance over a 2-year period highlights the underlying momentum of the business, particularly in beauty and well-being, home care and personal care. We delivered compounded annual volume growth of 3.6%, 3.1% and 2.1% respectively. In 2025, we saw a clear sequential improvement through the year.
A new slide appears to Srinivas's right, titled Q4 2025. It shows 3 figures: 4.2% underlying sales growth, 2.1% underlying volume growth, and 2.0% underlying price growth.
With Q4 growth at 4.2%, with a step up in volumes to 2.1% and pricing at 2%. This reflects our disciplined execution and a sharper focus on volume-led growth.
A new slide appears to Srinivas's right, titled Full Year 2025, with the subtitle Power Brands. It shows 3 figures: 4.3% underlying sales growth, 2.2% underlying volume growth, and 2.0% underlying price growth.
Our 30 power brands, which represent more than 78% of the group turnover, continue to grow ahead of the average, delivering 4.3% underlying sales growth for the full year, with volumes up 2.2%, in line with our medium-term growth algorithm. This performance has been sustained over time, with power brands delivering a 2-year compounded annual growth rate of 5%, including 3.4% volume growth. Power brands have the first call our incremental resources, with 100% of our incremental BMI in 2025 being invested behind them. The performance we see reflects the impact of those prioritization choices.
A new slide appears to Srinivas's right, titled Q4 2025, with the subtitle Power Brands. It shows 3 figures: 5.8% underlying sales growth, 3.5% underlying volume growth, and 2.2% underlying price growth.
Momentum strengthened further in the fourth quarter, with power brands delivering growth of 5.8%, driven by volume growth of 3.5%.
A new slide appears to Srinivas's right, titled Beauty and Well-being. Below, the text reads, Dove, Vaseline and premium portfolio continue to outperform. It shows 3 figures: 4.3% underlying sales growth, 2.2% underlying volume growth, and 2.1% underlying sales growth.
Beauty and well-being delivered balanced growth across the year, with underlying sales growth of 4.3%, evenly split between volume of 2.2% and price at 2.1%. Dove, Vaseline, and our premium brands continued to outperform, delivering double-digit growth, reflecting the strength of our innovation and focused execution. Category performance varied across the year, reflecting different stages of portfolio reshaping, innovation delivery, and execution. Hair care was flat overall, with pricing offset by lower volumes. Within this context, Dove Hair continued to deliver double-digit growth, driven by the rollout of its fiber repair range across multiple markets. Total hair care performance in North America was flat, reflecting portfolio simplification actions, while softer market conditions in some emerging markets weighed on volumes. Core skincare delivered mid-single-digit growth. Vaseline again stood out, delivering double-digit growth for the 3rd consecutive year and becoming our 8th largest brand. Well-being remained a key growth engine, delivering double-digit growth for the year, led by volume. Liquid IV and Nutrafol both delivered double-digit growth, with Liquid IV reaching 2 important milestones: becoming a billion-dollar brand and achieving a record US household penetration of over 18%. Olly delivered high single-digit growth, and it is now an over $500 million brand. Prestige Beauty delivered low single-digit growth. Hourglass and K18 continued to grow double-digit, and Dermalogica and Paula's Choice returned to growth in the second half.
A new slide appears titled Beauty and Well-being, 12.8 billion euros turnover, 19.2% underlying operating margin, negative 20 basis points versus prior year. A short line beneath the title reads, Dove, Vaseline and premium portfolio continue to outperform. On the left, a panel labelled Full Year 2025 presents the division's growth figures. It shows underlying sales growth of 4.3%, underlying volume growth of 2.2%, and underlying price growth of 2.1%. To the right of these figures, a multi-quarter performance chart shows results across Q4 2024, Q1 2025, Q2 2025, Q3 2025, and Q4 2025. The chart displays three measures: underlying price growth as lighter bars, underlying volume growth as darker bars, underlying sales growth as a line. The figures are as follows. Q4 2024. Underlying sales growth is 5.2% with underlying volume growth at 3.9%. Q1 2025. Underlying sales growth is 4.1% with underlying volume growth at 2.5%. Q2 2025. Underlying sales growth is 3.4% with underlying volume growth at 1.0%. Q3 2025. Underlying sales growth is 5.1% with underlying volume growth at 2.3%. Q4 2025. Underlying sales growth is 4.7% with underlying volume growth at 2.8%. At the bottom of the slide, three boxed statements summarize category performance. Double-digit growth in Dove, Vaseline, Hourglass, K18, Liquid IV, and Nutrafol. Well-being grew double-digit in weaker markets. Prestige delivered low single-digit growth. Q4 performance driven by a volume step-up in core skincare and hair care across key Asia-Pacific Africa markets. On the right side of the slide, large product visuals show a range of Vaseline Gluta-Hya lip serum tubes in different colors.
In the fourth quarter, beauty and well-being growth stepped up to 4.7% with volumes up 2.8%. This performance underpins a two-year compounded annual volume growth rate of 3.3%, reflecting improved execution and a stronger performance across several key Asia-Pacific Africa markets as the year progressed. While market growth moderated in well-being, we delivered volume growth above 5% for the quarter, continuing to materially outperform the market. Meanwhile, our core portfolio delivered improved growth with hair care at mid-single-digit growth. From a profitability perspective, underlying operating profit in beauty and well-being was €2.5 billion in 2025, with an underlying operating margin at 19.2%, down 20 basis points year-on-year. This reflects a significant improvement in overhead efficiency, with increased brand and marketing investments behind power brands and premium innovations supporting long-term sustainable growth.
A new slide appears to Srinivas's right, titled Personal Care. A short line beneath the title reads, Renewed strength in the US driving overall competitive growth. It shows three figures: 4.7% underlying sales growth, 1.1% underlying volume growth, and 3.6% underlying price growth.
Personal care delivered underlying sales growth of 4.7% for the full year, with a much stronger competitive performance driven by the momentum in the United States. The US remains a big growth engine and a benchmark for execution across the business group. Price contributed 3.6%, largely reflecting commodity-driven increases, with volumes growing 1.1%, supported by premium innovations, particularly in Dove, which delivered high single-digit growth. Strong volume growth in developed markets led by North America more than offset softer conditions in Latin America, where volumes declined, but the performance remained ahead of the category. Deodorants delivered low single-digit growth, supported by both price and volume. Dove again led performance, delivering double-digit growth, with scaling of whole-body deos across 15 markets, reinforcing our leadership in the category. In the fourth quarter, growth improved sequentially to mid-single-digit as actions to address product format mix in Brazil began to gain traction. Skin cleansing delivered mid-single-digit growth led by price and continued premiumization. Oral care also delivered mid-single-digit growth, driven by strong performances in Close-Up and Pepsodent, with premium whitening and naturals innovations in Asia-Pacific Africa. During the year, we further strengthened personal care's portfolio through the acquisitions of Wild and Dr. Squatch. These acquisitions enhance our exposure to premium segments and are expected to contribute meaningfully to growth over time.
A new slide appears titled Personal Care, €13.2 billion turnover, 22.6% underlying operating margin, plus 50 basis points versus prior year. A short line beneath the title reads, renewed strength in the US driving overall competitive growth. On the left, a panel labelled Full Year 2025 presents the division's growth figures. It shows underlying sales growth of 4.7%, underlying volume growth of 1.1%, and underlying price growth of 3.3%. To the right of these figures, a multi-quarter performance chart shows results across Q4 2024, Q1 2025, Q2 2025, Q3 2025, and Q4 2025. The chart displays three measures: underlying price growth as lighter bars, underlying volume growth as darker bars, underlying sales growth as a line. The figures are as follows. Q4 2024. Underlying sales growth is 5.3%, with underlying volume growth at 3.6%. Q1 2025. Underlying sales growth is 5.1%, with underlying volume growth at 2.7%. Q2 2025. Underlying sales growth is 4.5%, with underlying volume growth at 0.2%. Q3 2025. Underlying sales growth is 4.1%, with underlying volume growth at 1.0%. Q4 2025. Underlying sales growth is 5.1%, with underlying volume growth at 0.6%. At the bottom of the slide, three boxed statements summarize category performance. Dove delivered high single-digit growth driven by premium innovations. Deodorants grew low single-digit, impacted by a decline in Latin America, with improvement in Q4. Strong growth in Q4 led by North America and Asia-Pacific Africa. Additions of Dr. Squatch and Wild further enhancing premium portfolio. On the right side of the slide, large product visuals show Dove whole-body deodorant products in white packaging.
In the fourth quarter, underlying sales growth remained strong at 5.1%, led by North America and Asia-Pacific Africa. Growth was driven by price and supported by positive volume, reflecting the positive trajectory of the business and the sustainability of US-led momentum. From a profitability perspective, underlying operating profit in personal care was 3 billion euros. Underlying operating margin increased by 50 basis points to 22.6%, driven by improvements in gross margin and overhead efficiency. We continue to invest behind our brands, most notably in the US and in the premium segments, in line with our strategic priorities.
A new slide appears to Srinivas's right, titled Home Care. A short line beneath the title reads, Volume acceleration supported by premium innovations. It shows three figures: 2.6% underlying sales growth, 2.2% underlying volume growth, and 0.4% underlying price growth.
Home care delivered underlying sales growth of 2.6% for the year, with growth primarily being volume-led at 2.2% and a modest contribution from price of 0.4%. Performance improved sequentially through the year, supported by strong growth momentum in Europe, driven by premium innovations, and improved execution and performance in India. Fabric cleaning was flat, as strong performance in Europe was offset by a softer performance in Brazil, where corrective pricing actions were taken earlier in the year to restore competitiveness. Wonder Wash continues to go from strength to strength, following its launch in 2024, and it's now established in more than 30 markets. This demonstrates the speed at which we can roll out high-impact innovations at scale. Home and hygiene delivered mid-single-digit growth led by Cif and Domestos. Growth was supported by premium innovations including Cif Infinite Clean and the continued rollout of Domestos Power Foam beyond Europe, extending our leadership in hygiene formats. Fabric enhancers delivered high single-digit growth led by volume. Comfort, one of our billion-euro brands, performed particularly well, supported by premium formats and fragrance-led innovation, with strong momentum across several emerging markets.
A new slide appears titled Home Care, 11.6 billion euros turnover, 14.9% underlying operating margin, plus 40 basis points versus prior year. A short line beneath the title reads, Volume acceleration supported by premium innovations. On the left, a panel labelled Full Year 2025 presents the division's growth figures. It shows underlying sales growth of 2.6%, underlying volume growth of 2.2%, and underlying price growth of 0.4%. To the right of these figures, a multi-quarter performance chart shows results across Q4 2024, Q1 2025, Q2 2025, Q3 2025, and Q4 2025. The chart displays three measures: underlying price growth as lighter bars, underlying volume growth as darker bars, underlying sales growth as a line. The figures are as follows. Q4 2024. Underlying sales growth is 3.0%, with underlying volume growth at 3.3%. Q1 2025. Underlying sales growth is 0.9%, with underlying volume growth at 1.0%. Q2 2025. Underlying sales growth is 1.8%, with underlying volume growth at 1.3%. Q3 2025. Underlying sales growth is 3.1%, with underlying volume growth at 2.5%. Q4 2025. Underlying sales growth is 4.7%, with underlying volume growth at 4.0%. At the bottom of the slide, three boxed statements summarize category performance. Fabric cleaning was flat, with strong growth in fabric enhancers and home and hygiene. Strong performance from science-led innovations led by Persil Wonder Wash, now in 30 markets. Q4 acceleration with return to growth in Brazil and continued strong volumes in India. On the right side of the slide, large product visuals show Persil Wonder Wash detergent bottles in purple and light blue packaging.
In the fourth quarter, growth accelerated to 4.7%, driven by 4% volume growth, underlining the recovery of the business. India was a key contributor to this momentum, with home care delivering mid-single-digit volume growth, led by strong performance in liquids across fabric wash and household care, and reaching its highest ever market share. Brazil, home care's second largest market, also returned to growth in the quarter, further supporting the overall improvement. From a profitability perspective, underlying operating profit in home care was 1.7 billion euros, with an underlying operating margin of 14.9%, up 40 basis points year-on-year. This reflects improved overhead efficiencies and disciplined brand investments, focused on fewer high-impact innovations, partly offset by a decline in gross margin.
A new slide appears to Srinivas's right, titled Foods. A short line beneath the title reads, Competitive growth led by Hellmann's with strong margin expansion. It shows three figures: 2.5% underlying sales growth, 0.8% underlying volume growth, and 1.7% underlying price growth.
Foods delivered underlying sales growth of 2.5% for the year, with 0.8% from volume and 1.7% from price. Growth was ahead of the market, driven by strong performance in emerging markets, while developed markets were broadly flat amid weaker consumer demand. Against that backdrop, this represents a solid performance with clear evidence of competitiveness across our core brands. Hellmann's continued to perform well, delivering mid-single-digit volume-led growth for the year. This was supported by the continued strength of its flavored mayonnaise range, now scaled across more than 30 markets and established as a 100 million euros platform, demonstrating our ability to premiumize at scale. Cooking aids delivered low single-digit growth, driven primarily by price. Knorr grew low single-digit, with softer retail conditions in developed markets offset by volume and price growth in emerging markets. Unilever Food Solutions was flat. Volumes were positive in North America, offset by declines in China, reflecting a weaker out-of-home consumption. We expect the UFS performance in China to improve during 2026.
A new slide appears titled Foods, 12.9 billion euros turnover, 22.6% underlying operating margin, plus 130 basis points versus prior year. A short line beneath the title reads, Competitive growth led by Hellmann's with strong margin expansion. On the left, a panel labelled Full Year 2025 presents the division's growth figures. It shows underlying sales growth of 2.5%, underlying volume growth of 0.8%, and underlying price growth of 1.7%. To the right of these figures, a multi-quarter performance chart shows results across Q4 2024, Q1 2025, Q2 2025, Q3 2025, and Q4 2025. The chart displays three measures: underlying price growth as lighter bars, underlying volume growth as darker bars, underlying sales growth as a line. The figures are as follows. Q4 2024. Underlying sales growth is 2.6%, with underlying volume growth at 0.5%. Q1 2025. Underlying sales growth is 1.6%, with underlying volume growth at negative 1.1%. Q2 2025. Underlying sales growth is 2.8%, with underlying volume growth at 1.7%. Q3 2025. Underlying sales growth is 3.4%, with underlying volume growth at 1.3%. Q4 2025. Underlying sales growth is 2.3%, with underlying volume growth at 1.3%. At the bottom of the slide, three boxed statements summarize category performance. Hellmann's grew mid-single digit with strong flavoured mayonnaise performance. Cooking aids grew low single digit, affected by a flat performance of UFS. Q4 growth led by strength in Asia-Pacific Africa, partially offset by softer European market. On the right side of the slide, large product visuals show Hellmann's mayonnaise and creamy ranch bottles.
In the fourth quarter, underlying sales growth was 2.3%, with volumes up 1.3%, reflecting a market environment that remained subdued into year-end. From a profitability perspective, Foods delivered a record year with underlying operating margin increased by 130 basis points to 22.6%, the highest level achieved by the business group. Underlying operating profit was 2.9 billion euros. This reflected portfolio pruning, disciplined pricing, productivity gains in gross margin, tight overhead control, alongside continued focused brand investments in line with our food strategy. We delivered balanced growth across developed and emerging markets, despite a more uneven macro and consumer backdrop through the year. This highlights the advantage of our geographic footprint. In developed markets, we grew ahead of our categories despite consumer conditions softening, particularly in the second half. In emerging markets, performance improved throughout the year, reflecting decisive actions we took to address challenges, alongside improved execution, a step up in innovation, and a more focused channel execution, as well as an improving trading environment in several key markets. Developed markets, which represent 41% of the group turnover, delivered underlying sales growth of 3.6% for the year, a sustained outperformance versus the market. Growth moderated in the second half as the macro and the consumer backdrop softened, with fourth quarter underlying sales growth of 1.7%, with slower market growth in both US and Europe.
A new slide appears to Srinivas's right titled North America. A short line beneath the title reads 22% of group turnover. It shows three figures: 5.3% underlying sales growth, 3.8% underlying volume growth, and 1.4% underlying price growth.
North America was a standout performer. Underlying sales grew 5.3% for the year, with volumes contributing 3.8%, reflecting continued share gains and the benefits of multi-year reshaping of our portfolio towards beauty and well-being and personal care.
A new slide appears to Srinivas's right titled North America, with the subtitle 22% of group turnover. A bullet point on the slide reads, volume-led growth ahead of the market driven by beauty and well-being and personal care. A second bullet point appears which reads, premium innovations enhanced by strong retailer support drove performance.
Premium innovations supported by strong retail execution continue to underpin growth, allowing us to outperform the markets despite more subdued consumer conditions.
A third bullet point appears which reads, Q4 market outperformance despite subdued US market.
In the fourth quarter, growth moderated as category conditions softened across the segments. Despite this, our portfolio performance remained resilient, reflecting the strength of our portfolio and execution.
A new slide appears to Srinivas's right titled Europe, with the subtitle 19% of group turnover. It shows three figures: 1.5% underlying sales growth, 1.2% underlying volume growth, and 0.3% underlying price growth.
Europe delivered low single-digit underlying sales growth for the year.
The growth figures fade from the slide. In their place, a bullet point appears, which reads, Home care and personal care performed well, with strong premium innovations and execution.
Home care and personal care performed well, supported by the volume growth and the continued rollout of Wonder Wash and whole body deodorants. This was partly offset by softer conditions in foods, where we continued to outperform the market.
A second bullet point appears, which reads, Foods declined but outperformed a soft market.
Growth across Europe was uneven, with good momentum in France and Italy, offset by softness in Germany.
A third bullet point appears, which reads, Q4 performance reflected continued subdued markets.
In the fourth quarter, underlying sales were flat, in line with the slowing market environment, but our performance remained robust relative to the categories. Emerging markets, which account for 59% of the group turnover, delivered underlying sales growth of 3.5% for the year. Performance improved sequentially through the year, with growth accelerating to 5.8% in the fourth quarter, including 3.2% volume growth, reflecting the impact of decisive actions taken earlier in the year, alongside a return to growth in Latin America.
A new slide appears to Srinivas's right titled Asia Pacific Africa, with a subtitle reading 44% of group turnover. It shows three figures: 4.6% underlying sales growth, 3.0% underlying volume growth, and 1.6% underlying price growth.
Asia Pacific Africa delivered underlying sales growth of 4.6% for the year, with volumes contributing 3% and price 1.6%, reflecting strengthening of execution across several key markets. Momentum strengthened in the fourth quarter, with APA delivering underlying sales growth of 6.9%, driven by volume growth of 5.7%.
The growth figures fade from the slide. In their place, a bullet point appears, which reads, India growth strengthened in a gradually improving market, with continued share gains.
In India, underlying sales grew 4% for the year, with volumes up 3%. Growth accelerated in the fourth quarter to 5%, with volumes up 4%, reflecting market share gains, a gradual recovery in market growth, and the normalization of the trade environment following GST adjustments in the third quarter. Performance was led by our premium personal care portfolio and strong execution in laundry liquids.
A second bullet point appears, which reads, Indonesia returned to growth in the second half, with run rates improving sequentially.
In Indonesia, underlying sales grew at 4% for the year, with a sharp recovery in the second half, following a comprehensive reset of the business. Alongside price stabilization and trade stock normalization, we stepped up innovation and significantly increased social-first brand activation, strengthening relevance and demand across our core categories. As execution improved, availability and affordability were sharpened. The performance stepped up materially, with growth accelerating to 17% in the fourth quarter against soft prior comparators.
A third bullet point appears, which reads, China showed improved growth as we strengthened our go-to-market strategy.
In China, underlying sales growth were flat for the year, with clear improvement in the second half, including mid-single-digit growth in the fourth quarter. Actions to reset the business, including strengthening of go-to-market execution and accelerating premiumization, supported this improvement. This was led by beauty and well-being and personal care, despite overall market growth remaining weak.
A new slide appears to Srinivas's right titled Latin America, with a subtitle reading 15% of group turnover. It shows three figures: 0.5% underlying sales growth, negative 2.6% underlying volume growth, and 2.9% underlying price growth.
In Latin America, underlying sales grew 0.5% for the year, reflecting a broad-based market slowdown amid ongoing macro and political uncertainty. Price growth of 5.9% largely offset a volume decline of 5.1%, with elevated price elasticity continuing to wane on volumes as consumer demand remained under pressure.
The growth figures fade from the slide. In their place, two bullet points appear. The first reads, Broad-based market slowdown amidst ongoing macro uncertainty. The second reads, Q4 returned to growth, showing early signs of stabilization.
The region, however, returned to growth in the fourth quarter.
A third bullet point appears, which reads, Beauty and Wellbeing and Foods delivered low single-digit growth.
For the year, Beauty and Wellbeing and Foods both delivered low single-digit growth. In Foods, performance was supported by Hellmann's, led by the continued strength of the flavored mayonnaise range in Brazil. In Beauty and Wellbeing, growth reflected improved execution and the strength of the core brands. During the year, we took targeted actions in Brazil to restore competitiveness, including corrective pricing in fabric cleaning and adjustments to the format mix in deodorants. Home care returned to growth in the fourth quarter, providing a clear indication that these actions are beginning to gain traction. One Unilever markets delivered mid-single-digit growth with positive volume and price and were accretive to both group sales and profit growth in 2025. This performance reflects the benefits of radical prioritization and sharper focus in our smaller markets.
A new slide appears titled, Reported Turnover Reflects Net Disposals and Adverse Currency. A simple chart fills the screen, showing two dark blue columns connected by a horizontal line. On the left, the first column is labelled FY 2024 turnover, €52.5 billion. On the right, the second column shows FY 2025 turnover, €50.5 billion. At the centre of the connecting line, a dark oval displays negative 3.8%, indicating a year-on-year decline in reported turnover.
Turnover for the full year was €50.5 billion, down 3.8% versus the prior year. This was driven by significant currency headwinds, with FX reducing turnover by 5.9%.
The same slide remains on screen, showing the two turnover columns and the negative 3.8% change between FY 2024 and FY 2025. A small red box now appears between the two columns, labelled Currency and marked negative 5.9%, highlighting the adverse currency impact contributing to the decline.
The currency impact was broad-based, reflecting a weaker US dollar alongside depreciation across a number of emerging market currencies, including several of our large markets. This was only marginally offset by strength in a small number of currencies.
Between the columns, a white inset box appears labelled USG 3.5%, breaking this down into two green bars, 1.5% for UVG and 2.0% for UPG. To the right, a red box marked negative 5.9% highlights the currency impact.
Excluding currency, turnover increased by 2.3%, driven by underlying sales growth of 3.5%, partly offset by portfolio actions as we continued to sharpen the business.
A second white inset box now appears beside the USG breakdown, labelled Acquisitions and Disposals, negative 1.2%. Inside it, a single green bar marked 0.6% represents acquisitions, adding another element to the bridge between the two turnover columns.
The net impact from acquisitions and disposals was negative 1.2%. Within this, acquisitions contributed 0.6%, driven by Minimalist, Wild, and Dr. Squatch, all performing in line with their acquisition business cases.
Within the acquisitions and disposals box, a red bar now appears labelled negative 1.8%, representing disposals and completing the acquisitions and disposals breakdown.
This was more than offset by a disposal impact of 1.8%, reflecting the exits of Unilever Russia and the China water purification business in 2024. Disposals of Conimex, The Vegetarian Butcher, and Kate Somerville were completed during 2025.
A new slide appears titled Structurally Higher Underlying Operating Margin. A clean chart spans the screen, showing two dark blue columns connected by a horizontal line. On the left, the first column is labelled FY 2024 UOM 19.4%. On the right, a second column shows FY 2025 UOM 20.0%. At the centre of the connecting line, a dark oval displays 60 basis points, indicating the year-on-year improvement in underlying operating margin.
Underlying operating margin expanded by 60 basis points to 20% in 2025, reflecting a structurally strong margin profile.
Between the two columns, a green bar labelled 0.2% appears above the axis under gross margin. Below it, a text box reads, Execution strength offsetting input and market volatility, explaining the driver behind the improvement in margin.
Gross margin contributed positively, expanding by 20 basis points and marking a third consecutive year of gross margin expansion. Importantly, following the ice cream's demerger, gross margin now is at structurally higher level of 46.9%. This reflects a fundamental shift in the shape of the group, alongside improvements in mix, price, and sustained delivery of savings.
Further to the right, a second green bar labelled 0.5% appears above the axis under overheads. Beneath it, a text box reads, Productivity Program delivered ahead of plan, highlighting an additional driver of the margin improvement.
Our productivity program and the ongoing cultural shift enabled a further 50 basis points reduction in the overheads. Since the program began, we have delivered more than 670 million euros of savings and are well ahead of the plan. We remain on track to complete the 800 million euros program in 2026.
Between the two existing green bars, a small red bar labelled negative 0.1% now appears above the axis under BMI, indicating a slight offset within the bridge.
Brand and marketing investment increased by 10 basis points to 16.1% of turnover, the highest percentage in over a decade, and 300 basis points higher than 4 years ago. This reflects a clear choice to prioritize investment behind our strongest brands and innovations, consistent with our focus on sustainable growth and long-term value creation. 100% of the incremental BMI was allocated behind beauty and well-being and personal care. Underlying operating profit was 10.1 billion euros, a decline of 1.1% versus prior year. In line with our multi-year priority, in 2025, we delivered hard currency underlying earnings growth.
A new slide appears titled Underlying EPS Growth Despite Adverse Currency. A clean chart spans the screen, with two dark blue columns connected by a horizontal line. On the left, the first column is labelled FY 2024 Underlying Earnings Per Share, 3.06 euros. On the right, a second column shows FY 2025 Underlying Earnings Per Share, 3.08 euros. At the centre of the connecting line, a dark oval displays 0.7%, indicating the year-on-year growth in underlying earnings per share. Between the two columns, a green bar labelled 6.5% appears under operational performance, showing the positive contribution driving EPS growth before currency effects.
Underlying EPS rose to 3.08 euros, up 0.7% versus the prior year, with sales growth and margin expansion together contributing 6.5% to EPS growth.
To the right of the green bar, a small red bar labelled negative 0.2% appears under finance costs.
Net finance costs were broadly flat year-on-year, reflecting active balance sheet management and disciplined funding decisions. Net finance costs represented 2.1% of average net debt, underscoring the resilience of our financing structure following the ice cream separation.
Further to the right, a green bar labelled 1.3% appears under tax.
Tax contributed positively, adding 1.3% to underlying earnings per share, as the underlying effective tax rate decreased slightly to 25.7%. This reduction reflects the mix of earnings and the benefits of local tax optimization measures.
To the right of the tax bar, a further green bar labelled 1.5% appears under share buybacks. Next to it, a smaller green bar labelled 0.4% appears under minorities and other.
Our share buyback programs contributed 1.5% to underlying EPS.
To the right of the minorities and other bar, a large red bar labelled negative 8.8% appears under currency.
These positives were morely offset by currency, which had a negative impact of 8.8% on the underlying earnings per share. On a constant currency basis, underlying earnings per share grew by 9.5%. Following the separation of ice creams, an 8-for-9 share consolidation was implemented in December 2025 to ensure comparability of earnings per share, share price and dividends, with prior periods being restated accordingly. Sustainability remains a fundamental part of Unilever's strategy and is managed with the same discipline as our financial performance, with clear accountability and a direct link to remuneration. In 2025, we reached an important milestone on plastics, delivering both on our multi-year targets due this year. This reflects sustained focus and investments and demonstrates our ability to deliver against complex commitments.
A new slide appears to Srinivas's right titled Cash Generation. A large figure reads 100%, with a line beneath it stating FY 2025 cash conversion. Below, a second figure reads 5.9 billion euros, followed by the caption Free cash flow in FY 2025.
Free cash flow for the year was 5.9 billion euros, representing 100% cash conversion. Compared with the previous years, free cash flow was around 400 million euros lower, reflecting costs associated with the ice cream demerger, including separation-related tax on disposals. Excluding these demerger-related items, free cash flow was 6.3 billion euros, underlining the cash-generating strength of the business. Net debt at the year-end was 23.1 billion euros, an absolute reduction of 1.4 billion euros following the ice cream separation. This reflects the combined impact of cash generation and the demerger, offset by dividends, acquisitions, and share buybacks.
A new slide appears to Srinivas's right titled Balance Sheet. A large figure reads 2.0 times, with a line beneath it stating Net Debt/Underlying EBITDA. Below, a second line reads 1.4 billion euros absolute net debt reduction post the ice cream demerger.
Net debt to underlying EBITDA closed at 2 times, remaining within our target range and consistent with our capital structure objectives.
A new slide appears to Srinivas's right titled ROIC. A large figure reads 19.0%, with a line beneath it stating Underlying ROIC. Below, a line reads Top 1/3 ROIC in sector. Another line states Continued strong ROIC, with plus 100 basis point benefit post the ice cream demerger. A small footnote at the bottom reads Based on FY 2024 results for 18 company peer group.
Turning to returns, our underlying return on invested capital was 19%, placing us in the top third of the sector. Our ROIC benefited by around 100 basis points from ice cream demerger, reflecting the higher quality and the lower capital intensity of the group following the separation. Overall, ROIC remains firmly in the high teens, which we continue to view as a key guardrail for capital allocation and a core pillar of our multi-year value creation model. Our capital allocation is clear and disciplined and remains focused on 3 priorities: growth and productivity, actively shaping the portfolio, and delivering attractive capital returns.
A new slide appears titled Clear Capital Allocation Priorities. On the left side, a panel is labelled Growth and Productivity. A large figure reads 16.1%, followed by the line BMI as percent of turnover. Below a dividing line, another large figure reads 3.1%, with the label CapEx as percent of turnover. At the bottom of the panel, a line of text states, allocating greater than 50% of CapEx to productivity and margin initiatives.
Starting with growth and productivity, we continue to invest at scale where it matters most. Brand and marketing investment was 16.1% of turnover, while capital expenditure was 3.1% of turnover. Importantly, more than half the CapEx is directed towards productivity and margin initiatives, reflecting our focus on strengthening the underlying economics of the business while continuing to support our brands and innovation agenda.
To the right of the growth and productivity panel, a second panel appears titled Portfolio. A heading reads Bolt-on acquisitions focused on. Below it, a bulleted list states Beauty, well-being and personal care, premium segments, digitally native, DCOM exposure, US and India. At the bottom of the panel, a final line reads Selective disposals.
Turning to the portfolio, we remain value-focused. We are continuing to simplify the portfolio through targeted disposals while pursuing bolt-on acquisitions aligned to our strategy. Our focus remains on beauty and well-being and personal care, with emphasis on premium segments, digitally native brands, and e-commerce exposure, particularly in the US and India.
To the right of the portfolio panel, a third panel appears titled Capital Returns. At the top, a large figure reads 6.0 billion euros, followed by the line Capital Return to Shareholders in FY25. Below a dividing line, a second figure reads 4.5 billion euros, with the label dividends paid in FY25. At the bottom, a third figure reads €1.5 billion, followed by share buybacks completed in FY25.
Finally, on capital returns, we returned €6 billion to shareholders in 2025, comprising €4.5 billion in dividends and €1.5 billion in share buybacks. This reflects our capital allocation priorities with a clear preference to maintain in principle a 70-30 balance between dividends and share buybacks. Taken together, this provides consistency and visibility supported by strong cash generation and disciplined execution. We continue to transform the portfolio in 2025, allocating capital towards higher growth premium segments while exiting businesses that no longer fit our strategic direction. Taken together, 2025 represents a step change in portfolio transformation. With the ice cream demerger and 10 transactions completed or announced during the year, we materially increased the focus and the growth profile of the group.
A new slide appears titled Portfolio Focus to Drive Higher Growth. On the left, a panel is labelled Bolt-on Acquisitions. Centred within the panel, the brand name Minimalist is displayed. Below it appears the Dr. Squatch logo, featuring an illustrated character alongside the brand name. At the bottom of the panel, the name Wild is shown in large text.
On the acquisition side, the additions of Minimalist, Dr. Squatch, and Wild strengthen our exposure to beauty, well-being, and personal care, premium segments, and digitally native e-commerce-led brands, with particular emphasis on the US and India.
To the right, a second panel appears titled Selective Disposals. A vertical list displays the following names: Conimex, The Vegetarian Butcher, Kate Somerville, Graze, Indonesia Tea, and at the bottom, Home Care Colombia and Ecuador.
At the same time, we were decisive in simplifying the portfolio. We completed exits from lower growth or non-core businesses, including Conimex, The Vegetarian Butcher, and Kate Somerville, and announced further disposals such as Graze, Indonesia Tea, and the home care business in Colombia and Ecuador. These actions further sharpen the focus of the group and reduce complexity.
On the far right, a third panel appears titled Ice Cream Demerger. Centered within the panel is the logo reading The Magnum Ice Cream Company, with the Magnum brand displayed prominently above the words Ice Cream Company.
The ice cream demerger is the most significant step in this portfolio transformation. It reflects a deliberate decision to simplify the group, increase the strategic focus, enabling both Unilever and the ice cream business to pursue distinct strategies, capital structures, and growth priorities more effectively. Overall, the scale and pace of change in 2025 underlines that this is a different Unilever, one that is actively transforming its portfolio to drive higher quality growth and stronger returns over time. Turning to 2026, our outlook reflects the progress we have made and a disciplined focus on what we can control in a slower market environment.
A new slide appears titled Growth. Two key messages are shown. The first reads, Underlying sales growth at the bottom end of the 4 to 6% range. The second states, Underlying volume growth at 2% plus, outperforming slower markets.
On growth, we expect underlying sales growth for the full year to be at the bottom end of our multi-year range of 4 to 6%. We expect underlying volume growth of at least 2%, maintaining focus on our volume-led growth and outperforming slower markets.
A new slide appears titled Margin. Two key messages are shown. The first reads, Modest underlying operating margin improvement. The second states, Underpinned by strong gross margin.
On margins, we are confident of a further modest improvement to the underlying operating margin. Our structurally strong gross margin will continue to benefit from value chain interventions, fueling ongoing reinvestment into our brands. In 2026, we expect inflationary pressures in select commodities, with the overall inflation being lower than 2025. As before, margin progression is an outcome of our choices, not a short-term objective in its own right.
A new slide appears titled Capital Returns. Two key messages are shown. The first reads, New €1.5 billion share buyback announced. The second states, Sustained, attractive and growing dividends.
On capital returns, We have announced a new share buyback of 1.5 billion euros, reflecting confidence in the strength of our balance sheet and the consistency of our capital allocation framework. We also continue to expect sustained, attractive, and growing dividends supported by strong cash generation. With that, over to you, Fernando.
Thank you, Srini. As we look ahead, we expect conditions to remain challenging, with soft markets in many parts of the world. Our confidence in the future stems from the significant progress we made in 2025, and we enter 26 as a very different looking business, one that is not only simpler and more focused, but also now built to deliver consistently. We are building a sales and marketing machine founded on 3 fundamental shifts that transcend our whole business, with 7 clear growth priorities. Let me take them in turn.
A new slide appears to Fernando's right titled, A Simpler, Focused Company. The first key message reads, Brands, Desire at Scale.
The 3 fundamental shifts encompass our brands, our organization, and our people. Our brands are benefiting from a desire at scale model that is elevating every stage of the journey, from product development right through to the way we reach and engage with consumers, to the way we execute in both offline and online retail. Where fully deployed, we have seen incredibly strong performances in brands like Dove, Vaseline, Persil, and Hellmann's.
The second key message reads, Organization, Fit for the AI Age.
We are making our organization fit for the AI age, transforming every link in the value chain, particularly around the consumer. That means deploying AI to supercharge demand generation, scaling and hyper-targeting marketing content, partnering with consumer faces LLMs, and working with retailers on agentic shopping models, creating a future-fit model for how our brands are discovered and shopped.
The third key message reads, People, Play to Win.
And our people are embracing a new play-to-win philosophy and approach, where the demands may be greater, but where targets are sharper, accountability is clearer, potential rewards are higher, and with the highest ever differentiation between best and worst performers. When it comes to our growth priorities, this will be increasingly familiar to you by now. They involve honing in and doubling down on our biggest growth opportunities.
A new slide appears to Fernando's right titled, A Simpler, Focused Company. Below, a heading reads, More. A list of focus areas follows: beauty, well-being, personal care, United States, India, premium, and digital commerce.
Across categories with more beauty, more well-being, more personal care. Across geographies with US and India as clear anchor markets for Unilever. And across segments and channels, focusing on premiumizing the portfolio and further increasing our exposure to e-commerce. These 7 areas are already driving a large proportion of our growth. And with the additional focus on investment we are bringing to them, we see opportunities to go considerably further. I look forward to going deeper on these fundamental shifts and growth priorities at next week's CAGNY conference in Orlando. Nowhere does the robustness and validity of these transformational fundamental shifts and strategic growth priorities show up more clearly than in the strength and quality of our innovation program. You have seen in our results today how effective our premium innovation is when we create or grow categories like powder hydration, short-cycle laundry, probiotics in surface cleaning, flavor mayo, all powered by our superior science, irresistible aesthetics, and elevated sensorials.
A new slide fills the screen titled, 2026 Innovation and Activation Supports Volume Ambition. 4 animated panels move subtly into view. In beauty and well-being, Dove Hair Relaunch Biphasic Oil appears alongside Vaseline Gluto-Hya for body and lips. In home care, Cif Infinite Clean is shown next to Domestos Power Foam being poured into a toilet. In personal care, the FIFA World Cup 2026 logo appears with Dove Oil Plus Serum Body Wash and Dr. Squatch products. In foods, Hellmann's is featured over a sandwich being prepared, with the captions, Brand Aesthetics and New Flavors.
We are doubling down on this approach in 2026 with an excellent pipeline of innovation, leveraging our multi-year scientific streams and introducing new ones. And many of our personal care innovations will be activated alongside our sponsorship of the FIFA World Cup 2026, an exciting moment for us and our brands. A simpler, more focused company is not an end in itself. It is all about delivery, consistent delivery. That's what we are concentrated on, and while there is a lot more to do and more to prove, we are confident that 26 will be another big step forward in moving to a model and an approach that is built for delivery.
A new slide appears titled, Built to Deliver in Tougher Markets. The first bullet point reads, Clear metrics, volume growth, positive mix, and gross margin expansion.
The key elements are all there. First, our mantra is and will remain volume growth, positive means, and gross margin expansion. We are laser focused on these very clear metrics. This is the route to sustained success for Unilever and to top third shareholder returns, and we will continue to invest accordingly to achieve these objectives.
A second bullet point appears. It reads, Radical focus towards our strongest categories and brands.
Second, with the well-executed separation of ice cream now behind us, and with other recent bolt-on deals successfully completed, we have a sharper portfolio radically focused around our strongest categories and our biggest brand.
A third bullet point appears. It reads, Global strength, continued outperformance in DMs, EMs strengthening.
Third, with our emerging markets strengthening and developed markets continuing to outperform, we have a real opportunity now to leverage one of Unilever's most distinctive assets, our global strengths.
A fourth bullet point appears. It reads, Focused capital allocation, driving growth and productivity.
Fourth, our capital allocation priorities, as you heard from Srini, are crystal clear, focused on driving growth and productivity by supporting our brands, sharpening our portfolio, and maximizing margin initiatives, while at the same time delivering strong capital returns to shareholders.
A fifth bullet point appears. It reads, Accountability, lean structure, clear P&L owners, differentiated reward.
And finally, the extent of the organizational change at Unilever over recent years can hardly be overstated. The heavy lifting has been done. This is now a new business, simpler, leaner, more accountable, with P&L ownership now squarely in the hands of our category-led business groups, all backed up by differentiated reward to drive top performance. All these elements give us the confidence that we are moving towards a model and an organization built for consistent delivering, even in markets that will remain tough. Thank you for your attention. We look forward now to taking your questions.
Good morning, and many thanks for joining the call. If you would like to ask a question, please press star 1 on your telephone keypad. If you no longer wish to ask a question, press star 2 to exit the queue. When it is your turn to ask a question, your name will be called out. And finally, please keep your questions to a maximum of 2.
Thank you very much for joining the call. Our first question comes from Celine at JP Morgan. Celine, please go ahead. Celine. Moving to the second question, Warren. The second question comes from Warren Ackerman at Barclays. Warren, over to you, please.
Yeah, good morning, Fernando, Srini, Gemma. Warren here at Barclays. Can you hear me okay?
Yeah, we can.
Hi, Warren. An echo. Okay, super. So the first one, Fernando, can you talk a bit about the emerging market outlook for 2026? I'm thinking about the big four: Brazil, India, China, Indonesia. Can you maybe hit on some of the key topics that people are interested in? You know, the fix on Brazil DOs, for example. Is China and Indonesia a proper reset? Is it done? How should we think about volumes EM in 26? That's the first one. Second one, another geo one. It's on the US, obviously slowed versus Q3. Can you talk a little bit, Fernando, about where you see US category growth? Any signs of price pressure in the US, and your confidence about the 26 delivery? What kind of innovation pipeline, what kind of delivery should we expect out of the US in 26? And just quickly, if I can squeeze in the housekeeping for Srini, can you just tell us where the productivity savings landed, Srini? Is the 800 million done? And what should we think about productivity-wise in 26? Thank you.
Thank you, Warren. Good morning, everyone. Well, let me start saying that we consider our strengths in emerging markets a significant long-term competitive advantage, given the exposure it gives us to better population growth rate, wealth margin expansion, etc. And we have a portfolio in emerging markets that is really diversified in terms of geographies, categories, segment, price points, and this gives us resilience against volatility. We are very, very confident in our step up in emerging markets. We are seeing now, with the exception of LATAM, in which the market volume growth is flattish, we are seeing now growth in Asia Pacific, Africa, in the territory of 3% volume growth for the market. And our performance is improving across the board. In India, it's improving, both in terms of economic backgrounds and the fundamentals of the business, particularly the strengthening of our brand equities, our unmissable brand superiority scores in India are improving across the board. Our execution, particularly in rural areas and traditional trade, independent trade, is also improving. And we are growing shares, particularly in home care. We have achieved that, is 40% of our business there. We have achieved the highest ever share there in the last reading. China is slowly getting better. Growth has accelerated in second half 2025. We have made some significant interventions in the route to market of e-commerce. More work to do there, but we expect a better year in China in 2026. In Indonesia, we are very pleased with the renewed leadership team that we have put in place. They have done the right thing to reset the fundamentals of the business. We are now operating with very, very historic low levels of stock in our distributors. That has removed any fundamental issue of channel price conflict we have had in the past. We have relaunched our 8 top brands in the market. And of course, in Q4, we were benefited for a very weak comparator. But I feel the metric that we look obsessively in Indonesia is the improvement in our sales run rates. And every single quarter, we have been selling more in Indonesia in the last 4 quarters. Other markets like Vietnam, Pakistan, Bangladesh, Arabia are all also improving. We have significant operations in all these countries, so all this is growing nicely. Regarding LATAM, markets remain flattish. We have seen in the second half of last year around 0% growth, volume growth in Latin America. Macroeconomics remain challenging in Mexico and Brazil. But we are pleased with the return to growth in Q4, led by the great momentum in foods. We have a flying Hellmann's there, solid growth in beauty and well-being. I'm very, very pleased with the fast reaction in home care to the corrective actions that we have put in pricing to restore competitiveness. This is starting to bear fruits there. We expect improvements in deals in the next few months. Actions have been put in place to rebalance our investment, increasing the one in aerosol relative to the one in contact applicator formats. Reigniting growth in aerosol is absolutely critical, given the higher revenue per use and the higher profit per use. We are getting a lot of support from retailers in this aspect. We are resetting planograms in thousands of stores across the region, and we expect deals in Latin America to be a key contributor to growth from Q2 onwards. So in summary, optimistic about emerging markets in 2026. In US, let me start saying that our volume growth in North America in the last 3 years has been 3.9% in 2023, 4.2% in 2024, 3.8% in 2025. So this is a very consistent performance despite tough markets, probably one of the best performances in the sector. And this is a reflection of a profound transformation we have done in our portfolio, the setup of a US innovation model, and a huge focus in strengthening relationship with key retailers there. Q4 had a soft start, but we are encouraged by the fact that the market has rebounded in December and January. We are off to a good start in North America in 2026. Of course, we have seen some slowdown in well-being. Well-being in North America in the Q4 delivered around 5% volume growth when it was in double digit in the first 3 quarters. We have a couple of issues there. Fundamentally, the share of assortment of liquid IV in a key retailer of the club channel. Also some increase in the customer acquisition cost of our DTC business of Nutrafol. But we continue very, very confident in the structural growth in the verticals of well-being in which we compete and in our ability to continue expanding our leadership there. So optimistic about emerging markets, really optimistic about emerging markets. I believe that the solid delivery in US in the last 3 years give us confidence that we'll continue with outperforming the market there.
Thanks, Warren. On the productivity savings, I think we've said it in the press release, cumulatively we have now delivered about 670 million of savings. The program is ahead of our own plans and internal plans and schedule. Most of this benefit you will actually see in our SG&A line or general overheads line, while some part of it was in supply chain overheads. From a 2026 perspective, we expect to at least deliver the balance 130. That was a commitment we said about 800 million. And we'll continue to go further on that. And more as a cultural shift that we have really made in the company is, we'll continue to keep our SG&A costs and other overhead costs at run rates which are lower than the turnover. And therefore, in a sense, that productivity therefore becomes an ongoing habit.
Our next question comes from Guillaume at UBS. Go ahead, Guillaume.
Thank you.
Thank you very much, and good morning all. Couple of questions for me, please. The first one is on the pricing outlook for 2026. Fernando, can you maybe shed some light on how you expect price growth to play out this year, particularly given the sequentially, I think, lower inflationary pressures you're expecting for 26? And also, it seems a pickup in promo activities in many of your categories and regions. So it would be interesting to hear if you anticipate some maybe contrasted pricing developments by region or product category this year. And then the second question, probably for Srini, could you maybe walk us through the key building blocks that support your confidence in achieving this modest margin improvement in 26? And in terms of phasing, anything you would flag at this stage, be it for margin or for underlying sales growth? Thank you very much.
Thank you, Guillaume. Well, I feel that the category and geographical footprint of Unilever offer in the long run around 3% pricing. That's the kind of normal pricing we have seen in the last 10 years. This year we probably see that probably a bit lower than that, around 2%. We have seen some increased promotional spending, particularly in promotional intensity, particularly in foods, but it's not dramatic. We have not seen really an increase in promotional intensity in emerging markets. So overall, I would expect pricing to be around the 2% level. Commodity inflation, Srini can give a bit of background on that.
So you're absolutely right. I think Fernando summarized the pricing outlook quite well. In 2026, the commodity inflation is not going to be broad-based. It's actually concentrated in a few set of the materials, most notably really being palm kernel oil and surfactants, where we continue to see year-on-year pressure coming through. The second angle, which is important, and the first element that really comes from a home care and a personal care perspective, that's where we'll start to see elevated inflation in comparison to the other categories. The second aspect, which is important and sometimes overlooked, is that half our inflation classically comes from imported inflation or currency devaluation in the emerging markets, and therefore that becomes an important element. It's also equally important to highlight that in some other commodities, notably in some of the food side of it, or let's say crude related, including packaging, we are actually seeing deflation. So it's important in the first element to understand the difference between the different sets of the commodities that we have. Notwithstanding, we'll all recognize that there is also wage inflation which is happening in the markets, and that's also an important element which we'll have to cover through a combination of productivity and through pricing. Coming back to, I think, the point really on the building blocks and gross margin, it's actually been quite an incredible story. If you really read, we have now consecutively increased our gross margins for the last 3 years, and the increases have actually been sizable, over 330 basis points. What we now start at 46.9% is a structurally and a sustainably high gross margin business. And the levers in a manner are consistent with what we have been talking about. Mix plays a very important role for us through a combination of portfolio geography. We'll continue to drive that harder. Our savings program, notably in procurement, has actually demonstrated very differentiated capabilities now. On a consistent basis, we are actually beating across more commodities and markets. We're beating the market, and that's actually flowing into the bottom line. We have also significantly enhanced some of our commodity risk management practices. which is enabling us to use more of the tools and the instruments to really hedge and actually mitigate the risk for us. We've also talked about capital investment. More than 50% of our capital has been now consistently for the past 18-24 months being put towards savings, and that's something that we will continue. A combination of these elements, we are quite confident that our gross margin expansion in 2026 is likely to be higher than 2025. And that becomes actually a super important lever for us to actually continue to invest behind our brands. 25, we actually reached 16%. We'll continue to increase the spend, both on our power brands and also on our beauty and personal care businesses. And completing the picture, I did talk about overheads. Culturally and philosophically, we will keep overheads increases lower than sales. That means there is inherent productivity built into our plans. A combination of all of this actually then starts to give us a confidence to have a higher gross margin, which we'll reinvest and therefore deliver what we call is really a modest margin expansion. The last point in terms of your question on the phasing, while from a margin perspective, we don't expect material differences between half one and half two, it's important to highlight that we'll have slightly additional or higher headwinds of currency in half one. That's really reflecting what has happened in base period of 2025. But from a full year perspective, we should be in the right ballpark.
Thank you. Our next question comes from Jeremy at HSBC. Go ahead, Jeremy.
Hi, good morning. Thanks for taking a couple of questions from me. First one is on Europe. Perhaps you could just go into a little bit more detail on that. So it was sort of flattish at the end of the year. Was that reflecting kind of entirely slower markets, or did your relative performance slip a bit? And then what would the outlook for the region be in 2026? And then the second part was, I guess, the power brands versus everything else. I guess that was an unusually big difference from what I can remember in Q4. Perhaps you could talk about sort of the non-power brand stuff, because logically that was quite a lot weaker. Just kind of how you kind of intend to manage that sort of 25% of the business to make sure that it doesn't become too big a drag on your turnover, or whether you're happy with this sort of more dramatic power brand versus everything else growth that you saw in the quarter. Thanks.
Thank you, Jeremy. Well, in Europe, our performance, yes, there was some slowdown in Europe in the last quarter. We have seen markets getting a bit more flattish in Europe. We continue outperforming the market, particularly in home care and personal care. They continue performing really well. Our home care business is gaining share broad-based, across laundry and household care. And our deodorants business really performing also very, very strong. We have a strong innovation pipeline coming into 2026 in these categories. We continue thinking that we will remain strong when it comes to our competitiveness. We are in a round of negotiation with retailers at this stage. Everything is progressing well, so we don't expect any kind of big impact coming from that. Probably the biggest issue in Europe has been in foods. That has been relatively soft, particularly in Netherlands, Germany. We have very, very good performance in Italy and France overall, and UK has been solid for us. Poland has been a weak spot also. 40% of our European business is food, so that has an impact. But overall, we are confident that the kind of improved performance that we have had in Europe in the last couple of years, we can sustain that in average. When it comes to power brands and non-power brands are now 78% of our revenue. You probably remember that we used to call out around 75% 18 months ago. They are growing strongly. In the quarter 4, we grew close to 6% USG in power brands with 3.5% UVG. This is where we are concentrating all our incremental investment, particularly in the power brands of beauty, well-being, and personal care. When you look at the non-power brands, 22% of our revenue, for the year, we deliver a volume growth negative of 1%. It has accelerated to -3% in the quarter 4. There are some discontinuation that we have done in that quarter. And also there is some geographical elements that has played a role there. But we continue thinking that the strategy of focusing behind our most strongest assets is the right one. If you look at our beauty, well-being, and personal care combined, our performance has been, I believe, 4.5% growth for the year and 4.9% in quarter four. And if you look at power brands in that territory, it's close to 6%. So that's what we will continue putting the focus, and we will manage the rest of the portfolio accordingly. I would like to highlight also that the One Unilever markets, that are our smaller markets, have an excellent performance in 2025. This is an organization that we have put in place in 2025 with 35% reduction in headcount. It delivered 5.2% growth, and it have delivered an expansion of margin of more than 250 basis points. So smaller markets for us are a key engine for growth, but we are managing them in a simpler way, in a sharper way, with clear focus in the portfolio. They are focusing the portfolio there, and we are very confident about those geographies also.
Thank you. Our next question is coming from Celine at JPM. Celine, we'll try your line again. Celine, can you hear us?
Yes, can you hear me?
We can, thank you.
Excellent. Good morning. So I hope I'm not asking something that's already been asked, but my first question would be on the sequencing of growth for the year. So you're looking to grow around 4%. I understand maybe pricing 2 and volume above 2, but then you've been flagging probably some weakness in the US in the first quarter, and I presume a normalization in Asia, or at least in Indonesia. So can you talk about how we should expect these to evolve throughout the year? My second question is coming back on the well-being and beauty category. If you can talk about on the well-being side, what are you doing in the US to reconnect with growth? And as well, what is your expectation about internationalization on that business, and what can we expect that business, I would say, more normalized growth rate to be, if I could use that word? And I think on that division too, if you can talk about hair care and what we should expect for 26. Thank you.
Cool. Thank you, Celine. We are guiding our top line growth, at the lower end of our midterm guidance from 4 to 6%. If we are doing that, of course, there can be some quarters that can be below and some quarters that can be above that 4%, okay? So we will not guide on a quarterly basis. We have a good start in January, but, there is a lot to do in the next few weeks to close quarter one. But overall, we are confident that we will be delivering that 2+% volume growth for the year, and around 4%, at least 4% for the top line growth. Going into beauty and well-being, and what is the performance? As I mentioned before, if you look at beauty, well-being, and personal care, that combined business, because there are some brands that travel across the categories. We deliver an aggregated growth of 4.9% in the quarter four and 4.5% in the full year. And within beauty and personal care, we had another great year of our largest brand, Dove. It grew 9% with 7% volume growth, on top of another 7% volume growth in the previous year. I would like to highlight that. In the case of beauty and well-being, we saw a solid performance in skincare, great performance in Dove and Vaseline. Vaseline has delivered for the second year in a row double-digit volume growth. In hair care, we have been accelerating performance throughout the year. Dove Hair relaunch is a great success. We are seeing growth in markets like US about 20%. This mix is traveling globally, and the rollout is expected to be completed in all key markets by mid-26. And we expect better performance from Sunsilk and Clear that in 2025 were affected by the issues in Brazil and China. In prestige beauty, we accelerated also. The second half in 2025 was much better than the first half. We have great performances in brands like Hourglass and K18, our last acquisition. And in the retail channel for Dermalogica, we need to improve performance in Paula's Choice. There is a full relaunch of the brand ready for March this year. And we have to improve performance in the professional channel of Dermalogica, that is 30% of the brand. In well-being, another great year. If you look at each of our 3 biggest brands, Liquid IV, 16% growth, Nutrafol, 23% growth, Olly, 9% growth. All these brands are US-centric. We saw some softening in quarter four, some of that fundamentally linked to market growth. The volume growth we delivered in the quarter was about 5%. We expect a relatively soft quarter one due to strong comparators, but as I mentioned before, we are very confident on the structural growth potential of the well-being verticals in which we compete and in our ability to continue expanding the leadership positions our brands enjoy there. I highlighted before there are a couple of issues that we have to sort out. There was a decrease of share of assortment for liquid IV, an important customer of the club channel. And there is some increase in the customer acquisition cost in Nutrafol, but we have great teams working on that, and we will find the solution quickly.
Thank you. Our next question comes from Jeff at BNP. Go ahead, Jeff.
Good morning. Two questions, if I may. The first one is, with respect to innovation, you've made quite a few comments about it, but could you just tell us, what are the sort of big new innovations that you've got coming to market this year and we should be expecting to hear quite a lot about as the year progresses? And the second one, really just a housekeeping issue, but are you able to quantify the magnitude of the TSA receipts that you'll be getting from Magnum? Thank you.
Thank you, Jeff. Well, first of all, I would like to highlight that our first pennies goes to continue investing behind the innovations that have been very successful in the last few quarters. The Dove Hair relaunch, Persil Wonder Wash, Vaseline Gluta-Hya and Vaseline Pro-Derma, the flavor range of Hellmann's that is really driving significant growth. All these platforms are above the 100 million, 200 million euros, so this is really going very, very fast, and we continue investing behind them. There is new innovation hitting the market in multiple categories. I would like probably to mention, the UV repair range of Dove hitting the market in January in countries like China, Indonesia, Thailand, Vietnam, South Asia, Philippines. The Derma Scalp range of Dove Hair with focus in developed markets. I would call out particularly Vaseline Lips. That's a 100 million franchise already. We are gaining share in every single market around the globe. We see lips as an entry for younger users into Vaseline, and we are very excited with the kind of Gluta-Hya range in lip care that we are bringing into the market. The rollout of the Seal Press range of Tresemmé that has been a big success in India. We are rolling out that across Asia. Nexus, a big relaunch in US and significant innovation in China and Indonesia. In China, Nexus is really one highlight of our performance. In personal care, many things coming into the market, but I would like to highlight also the importance of the activation around the FIFA World Cup. This should be a real support for our performance, particularly in quarter 2, quarter 3. In foods, continuity to the development of Hellmann's flavor mayo, but we are entering with protein cups in Knorr, with a launch in US and scaling into European markets during the year. These are just some of the things that we are doing, so our innovation machine, I believe, has improved a lot in the last 2 to 3 years. Now our focus is ensuring that our execution capabilities are in line with the improvements that we have done in product development and innovation. But good plan for the year. And as I mentioned before, our absolute priority is in investing heavily behind the big winners that we have in the portfolio now.
On the TSA, Jeff, we are not actually quantifying externally the cost or the total cost of the TSA. Having said that, there are 3 important elements. It's a cost plus, and therefore there's a very small markup that we charge on these services. That's got to do with IT, and it's got to do with the other commercial services, mostly in the functions. Point number 2 is that most of these TSAs will actually, there are separate contracts, individual components. Between 26 and 2027, we expect most of them to really be taper off as the Magnum Ice Cream Company starts to take on these activities. Third element is that we have clear plans which are ensuring that we manage these contracts well. And more importantly, there are no stranded costs left at a Unilever level. So all in all, very clear plans to handle this for the benefit of both companies.
Thank you. Our next question comes from Olivier at Goldman Sachs. Go ahead, Olivier.
Good morning, Fernando, Srini, and Gemma. Could you please provide an update on the strategy for prestige beauty first? Some brands are doing great, like K18, Hourglass, other less so. Do you need more brands for the portfolio to reach a bigger scale? And what does the M&A landscape look like at the moment? And then secondly, going back to food, you had an amazing margin improvement. I think you reached 22.6% margins there. That's well above historical trends. What's the driver behind this improvement? How sustainable it is? And perhaps is Food Solution better margins than the rest? Thank you.
Cool. I will cover Prestige and Srini will cover the food margin question. In Prestige, you are right. We have had a great performance in brands like Hourglass, Tatcha, K18, not so well in Dermalogica, Paula's Choice. Even if Dermalogica in the retail is showing a lot of strength, but the brand is exposed to a professional channel that is declining, and we need to address some issues there. The Prestige market is changing dramatically, I feel you see less importance of travel retail, you see department store practically disappearing, you see a huge growth of the e-commerce channel, and I believe this gives us a lot of opportunities, and we consider our presence in Prestige a natural continuity of our presence in skincare and hair care. So that's how we see that. We are working in a much more integrated way. Particularly in areas like Asia, in which channels of specialist beauty are not so developed, and e-commerce is really taking the lead in developing the prestige market. We are always scanning the market for opportunities. Our acquisition criteria are very, very, very clear. We look at brands that are digitally native with a big exposure to e-commerce in categories in which we can add value, and there are a set of criteria that we follow with a lot of rigor. But we will not rush into acquisitions if the right asset doesn't emerge. And at this stage, we have not acquired in Prestige recently because we have not seen any asset that really fill any gap in the portfolio that we can have. But super committed to skincare, hair care. To a brand like Hourglass that is a real jewel in the color cosmetic super premium space. We see Prestige as a natural continuity of our presence in our skincare and hair care business.
On the foods margins, we are actually quite pleased with the way the whole business has been managed and being operated. There is a very sharp strategic choices that we made in terms of where to play, how to win. And what's also notable is actually the execution discipline which has come into this business, which is actually leading to a market outperformance across various markets and various segments. A lot of this really is read through gross margin. Some of the levers which I explained earlier are also applicable to the foods business, and therefore I will not repeat them. Having said that, foods business has also benefited significantly from some of the portfolio rationalization. We have over the past 18, 24, 36 months taken out or delisted the parts of the portfolio which were not value accretive. So I think that has really helped us. Second is we also have some very good, the whole pack price architecture, especially when it comes to Hellmann's and some of the innovations. Secondly, when it comes to the UFS business where we manage it extremely well with profitable accounts has also been a big driver for us. It's also important that the whole overheads element of savings which we have executed in the company are also benefiting from a foods perspective. Having said that, we continue to invest well. I think that's the most important element because we see foods as a growth business for us. So we are absolutely determined to invest to really grow the business. At an aggregate level, I think we are quite happy with the margins. The focus from here on for us is going to be more drive growth, volume-led growth, and not necessarily a big margin expansion.
Thank you. Our next question comes from Sarah at Morgan Stanley. Go ahead, Sarah.
Yes, morning. I have two questions, please. One was the impact of discontinuations generally across the group. Can you quantify that in terms of volume? And then the second one was on Dr. Squatch. Can you obviously that was growing super fast before you acquired it. Can you give us any idea how much that's growing during fiscal 26? Thanks. Oh, sorry, fiscal 25.
Yeah, I don't know if we will provide any discontinuation figure, Srini, but in Dr. Squatch, Of course, this is an important acquisition for us. It will only count in our underlying sales growth from September next year. But the performance has been good since acquisition, continue growing double digit. A strong brand, very distinctive proposition in the male grooming space, really making significant inroads, particularly in the deo category after establishing a very, very strong position in skin cleansing. So we are very pleased with having Dr. Squatch in our portfolio. We expect that to be a significant contributor to growth during 2026, but as I mentioned before, it will only count in our underlying sales growth from September onwards. But of course, pleased with the performance until now, absolutely in line with the business case that we have put at acquisition time.
Just a short one. See, anything that we actually do from an M&A or disposal perspective, you get full list of those disposals and the impact. Discontinuations and new launches of SKUs happen in the normal course of our business. Having said that, some of these discontinuations actually sit in the non-power brand section. And Fernando actually gave you a bit of a flavor in terms of whether it is the tail list of SKUs in beauty and well-being or some of the elements in foods. I think that's the right place to keep looking for it, and it gives you a bit of a sense in terms of what's happening there.
Thank you. Our next question comes from David at Jefferies. Go ahead, David.
Thanks, Gemma. Morning all. Just one from me, I think, in terms of the topic. Just Latin America, which I know you talked about a little bit, but it feels like that's recovered volume-wise a little bit quicker than maybe you were kind of indicating at the third quarter. So just whether that is the case, what was done better that meant that that's happened? I guess to some extent, was there innovations and relaunches that took place, and did that flatter the quarterly volumes in the fourth, maybe leading on to then saying, will volume growth you think be flat to positive in the first quarter or the first half? Thank you.
Yeah, we don't see in Latin America any performance that is fundamentally different to what we said to you, 1 quarter ago. The macro environment remains tough, both in Brazil and Mexico. And markets, as I mentioned, has been flattish. But we have intervened in some areas in which, as I mentioned before, we have scored some own goals, particularly in home care pricing and in Dio's format focus. Our food business continue performing very, very well, particularly Hellmann's, having a blast in Brazil, gaining share penetration, brand equity, and Beauty and Wellbeing have a solid performance. In the case of home care, as I mentioned, we are pleased with the reaction to our pricing correction. It's showing really impacting our volumes, particularly in Brazil. And in Dios, I believe there is much more to come. Some of the actions that we have taken are being implemented now, particularly the reset of planogram in thousands of stores across the region. We are really investing heavily behind the aerosol format that, as I mentioned before, has a much higher revenue per use and profit per use than some of the contact applicators. And we have a strong support from the retailers in that space. So we are confident for 2026 that Latin America will have a much better contribution to our performance. I have been associated with Latin America for many years. I have never seen 2 bad years in a row in Latin America. So we are very confident that we will deliver in that region, and the team is super, super committed in the region to improve performance there.
Thank you. Our next question comes from Tom at Deutsche Bank. Go ahead, Tom.
Yeah, morning everybody. Thank you. I wondered if you could just say a few words on the channel shift that is occurring in North America and how that's impacting you. We're obviously seeing very high growth on Amazon, and it appears that your shares are a bit lower on Amazon than they would be off. So what is the outlook for your share on that channel, and what's the effect of that channel growth? And particularly, I guess, as well, is just the growth of smaller peers and what that then does to the cadence of your innovation, because you're stating a lot of innovation globally, but it's not clear whether that is speeding up in any one particular market, if you say particularly North America. So are you combating the growth of smaller peers by fewer, bigger innovations or more iterative, please?
Thank you, Tom. Well, we continue having a strong performance in digital commerce, and I would say there are three types of digital commerce in which we have delivered strong performances. One is classic marketplace in North America, big retailers there like Amazon or Walmart.com. I have mentioned the performance last quarter. I will not repeat numbers today, but we are growing double digits with these people strongly in North America. Social commerce in places like Southeast Asia and China, and quick commerce in India. So in all of them, we are growing double digits. We are growing double digits through a special assortment of our core brands, and of course through the portfolio of new brands that we have been acquiring, particularly in the case of North America. Our focus in acquisition has been in digitally native brands with a strong exposure to e-commerce, and that has been working for us properly. We have not seen a significant slowdown in the North American market in the e-commerce side. Probably what you have seen, particularly in the months of October, that was very weak in the North American market. It was more related with physical stores, with the offline channel. There is always, of course, e-commerce opens an entry point to many small brands, but very few brands has been able to scale big. I continue thinking that brands like Dove or like Vaseline have significant competitive advantage also in online. And when I said before that the Dove is growing 7% volume globally, when you look at Dove growth in e-commerce, is practically 2 times that. So good performance in digital commerce. Of course, this is accelerating. Particularly in some markets in Asia, there is, I would say, a leapfrog of modern physical retail into e-commerce, but we are very well prepared to take advantage of that.
Thank you. Our final question comes from Ed Lewis at Rothschild. Go ahead, Ed.
Yes, thanks very much, everyone. A couple ones for me. I guess a lot of change, a lot of heavy lifting, as you said, Fernando, the last 2 years. So we think about 2026. Is this really the first year that we should start to see the benefits of the revamped approach to innovation that you introduced a couple of years ago? And then for Srini, just on the CapEx plans, over 3% of turnover, how much of CapEx will be spent on what you call margin-enhancing activities? I think you were close to around 60% last year.
Thank you, Ed. A lot of the heavy lifting has been done, I would say, particularly in terms of organization. And, if you think that last year we divisionalized our sales force, we separate ice cream, we made significant steps in our productivity program. All these are potential very disruptive initiatives. And the fact that we deliver a solid year in the context of all these initiatives, we consider that something important for us, Our product development, our innovation capabilities definitely are in a very different place to where they were 3 years ago. I would have not said 3 years ago that I would have been proud when I stand up in front of the Dove shelf or the Vaseline shelf. I am now. And that's basically a sentiment that I'm starting to experience with many, many of our brands, Of course, there are some elements in execution that has to improve, We have had issues of channel price conflict in some markets, some issues in countries like Brazil that should have not happened. We have launched a program of what we call Perfect Store in order to ensure that pricing, assortment, visibility are really properly managed and in a homogeneous way across Unilever. I'm really focusing to that now. But as you said, a lot of the heavy lifting has been done, and we see 2026 as a very important year to really bear some of the fruits of this effort, this investment that we have put in the business, both in terms of money and time and focus during all these years. Srini?
So on the CapEx for the past 2 years, we have actually been spending around the 3% level. And you're right that we are even from a 2026 point of view, we will look to spend anywhere about 55 to 60% going towards what we call as productivity or savings. From a capacity perspective, I think we are well covered, and therefore that gives us the ammunition to continue to drive the savings harder. Having said that, we are actually open to increasing the levels of CapEx to support the further growth and the productivity agenda, but with 2 caveats. One is obviously each of the business cases have to justify themselves, and we have actually taken up the thresholds in terms of both the IRRs as well as the payback periods, and these are non-negotiable. So each of the projects have to justify, and they justify, we will invest. That will not be a constraint. The second element is we are committed to maintaining 100% cash conversion. So therefore, we will generate this cash for us to be able to fund it. But our focus on leveraging productivity capex remains on track from 2026 perspective.
Cool. I believe there are no more questions. So thank you everyone for joining the call. Let me close saying that I hope it is clear that first we have delivered a very solid 2025 despite subdued markets and a very negative currency environment for Unilever. Second, that we enter 2026 as a simpler, more focused business with stronger brands and competitive level of investment. We're investing now 16% of our revenue in our brands. 3 years ago, we were at 13%. Third, that our geographical footprint is an asset, and we are very confident in a step up in emerging markets during 2026. And fourth, that our key metrics don't change. Volume growth, positive mix, and gross margin expansion to deliver earning growth in hard currency. That's where the whole company is focused on. Thank you very much.